Okay, let's unpack this. Today, we're embarking on a crucial deep dive into Section 4.3 of the FDIC Risk Management Manual of Examination Policies. We're focusing specifically on related organizations.
Right. And this isn't just about, parsing definitions. It's really about understanding the intricate, sometimes kind of veiled relationships that can profoundly impact an insured depository institution's safety and soundness.
Exactly. For you as an FDIC examiner, mastering this material is fundamental. It's really how you conduct thorough, effective examinations, how you proactively identify potential risks, and ensure robust regulatory compliance.
That's absolutely right. Our mission today is to distill the most important nuggets of knowledge from this section. We're aiming to give you a comprehensive yet concise overview of what constitutes a related organization.
And the regulatory framework governing them.
Yes, and critically, your specific examination authority and responsibilities.
Hmm.
We'll explore the statutory landscape. We'll delve into how major legislative shifts like the Gramm-Leach-Bliley Act, GLBA, transformed financial entities.
And the practical implications, right, for assessing risk and applying supervisory remedies.
Precisely. The goal is really to equip you with a clearer understanding of how these complex relationships manifest in the real world and, maybe more importantly, how to effectively evaluate their effect on the institutions you oversee.
So let's start at the very beginning then. Let's lay out the foundational framework. When we talk about regulating transactions between banks and their affiliated business organizations, where does the core statutory authority actually originate?
Okay, the bedrock for regulating these transactions is firmly established in Sections 23A and 23B of the Federal Reserve Act, or the FR Act. These sections are really foundational for governing how banks interact with what are termed affiliates.
Right.
Section 23A, in particular, it meticulously regulates transactions with affiliates, and that term is very specifically defined within the section itself. Then Section 23B comes along and broadens these restrictions. That was enacted as part of the Competitive Equality Banking Act of 1987, CEBA.
In SIBA, okay.
Together, they create a really crucial protective barrier for the bank.
And it's essential for our listeners, who are FDIC examiners, to understand that these aren't just for Federal Reserve member banks, correct? How do they extend to state non-member banks?
Indeed, that's a critical point for FDIC examiners. Section 18J of the Federal Deposit Insurance Act. The FDI Act explicitly extends the provisions of Sections 23A and 23B of the FR Act to state non-member banks.
Okay.
This ensures a consistent regulatory approach, regardless of the bank's charter type, which is vital for maintaining systemic stability.
Now, the financial landscape underwent a pretty dramatic transformation with the Gramm-Leach-Bliley Act, GLBA.
Yeah.
How did this landmark legislation impact these regulations and the broader financial environment we're operating in today?
Oh, GLBA was truly transformative. Its primary impact was fundamentally dismantling the old Glass-Steagall separations.
Right, the big walls came down.
Exactly. This meant banks, through their holding companies and subsidiaries, could now operate across traditional banking, securities, and insurance lines. That was a massive shift.
Huge.
It expanded their reach, but also introduced complex new layers of interconnected risk. While it amended numerous foundational laws across the financial services industry, the core takeaway is it ushered in an era of financial conglomeration. It profoundly altered the definition of a financial institution and the scope of permissible activities.
So with such sweeping changes, how then do we define an affiliate from an examination standpoint? It sounds like examiners need to be mindful of more than one definition here.
You're astute to pick up on that. The term affiliate actually carries dual definitions that you need to be keenly aware of as an examiner.
Okay.
It's specifically defined in Section 23A of the FR Act, which dictates the scope of covered transactions. But it's also defined in Section 3W6 of the FDI Act as having the same meaning as Section 2K of the Bank Holding Company Act, the BHC Act.
Oh, okay, two different sources.
Yes. And understanding these specific definitions is paramount because they dictate precisely which entities fall under regulatory scrutiny, and they really influence your examination approach.
And that leads directly to the FDIC's authority to examine these entities. Where does that power come from, allowing you, the examiner, to look beyond the immediate bank?
Our direct mandate comes from Section 10b-4 of the FDI Act. This is a powerful provision. It authorizes FDIC examiners in the course of examining insured banks to make such examinations of the affairs of any affiliate of any depository institution as may be necessary to disclose fully. And there are two parts. One, the relationship between such depository institution and any such affiliate, and two, the effect of such relationship on the depository institution.
That seems pretty clear-cut.
It is. This is your direct legal basis, a clear directive for looking into these related entities to understand their full impact on the bank.
It seems the FDIC's enforcement authority extends even beyond entities structured as traditional bank holding companies. Can you elaborate on how it reaches other parents and affiliates?
It absolutely does. The FDIC's enforcement power extends broadly to what are termed institution-affiliated parties, which are defined by Section 3 of the FDI Act.
Institution-affiliated parties.
Okay. It's a very broad term. It encompasses controlling stockholders, any person who participates in the conduct of an institution's affairs, or even independent contractors whose actions cause significant adverse effects.
Well,
And critically, this includes parent companies of industrial loan companies or ILCs and other non-bank charters entities that wouldn't necessarily be subject to the BHC Act.
right, the ones outside that traditional structure.
Exactly. The significance here is that under Section 8B of the FDI Act, the FDIC possesses the power to issue orders directly against these institution-affiliated parties.
Okay.
This allows for direct supervisory intervention when necessary, even if they aren't part of a traditional BHC structure.
So to sort of summarize what this entire manual, section 4.3 that we're diving into covers, it's really designed to provide a comprehensive understanding of these interconnected entities and your role as an examiner.
Precisely. This section of the manual thoroughly covers affiliates and subsidiaries. It delves into the restrictions on transactions between them and insured banks, outlines exceptions, and clearly defines the FDIC's examination authority, specifically concerning affiliates of non-member insured banks.
Got it.
Moreover, it meticulously discusses the major provisions of the GLBA and their profound impact on these transactions, as well as the statutory implications these changes have for the FDIC examination process as a whole. It's really designed to give you a holistic view and arm you with the necessary tools.
Okay, let's delve deeper into GLBA because it truly reshaped the financial services industry.
Yeah.
What were some of the key changes it brought in terms of expanded powers and maybe the restrictions it repealed?
Well, GLBA brought monumental shifts. As we mentioned, it significantly expanded the powers for bank subsidiaries of bank holding companies, enabling them to engage in a much broader range of financial activities, including things like offering insurance and securities products. The most famous outcome was the effective repeal of key restrictions of the Glass-Steagall Act. Specifically, Section 20, which had prohibited banks from affiliating with securities firms, was repealed.
Oh,
And Section 32, which prohibited interlocking directors between banks and securities firms, was also repealed. This marked a profound departure from decades of mandated banking separation, really paving the way for today's diversified financial services groups.
with these expanded powers, GLBA also authorized a new organizational structure, the Financial Holding Company, or FHC. What exactly is an FHC and what kind of activities can it now engage in?
Right, the FHC. The GLBA authorized the organization of financial holding companies under Section 4 of the BHC Act. An FHC gains broad latitude, allowing it to engage in any activity or acquire shares of any company engaged in any activity that the Federal Reserve Board, the FRB, determines to be either financial in nature, incidental to such financial activity, or even complementary to a financial activity, as long as it doesn't pose a substantial risk.
Doesn't pose a substantial risk to the institution or the system.
Exactly. To the safety or soundness of depository institutions or the financial system generally. It's a very broad grant of power.
Are there specific activities that are explicitly listed as financial in nature for these FHCs? I recall the outline mentioned a pretty detailed list.
Yes, the BHC Act does provide a comprehensive list. It includes traditional banking functions like lending and safeguarding money, of course, but it significantly expands into areas such as insuring, guaranteeing, or indemnifying against loss, issuing annuities, and providing various advisory services, whether financial, investment, or economic. Crucially, it explicitly covers securities underwriting, dealing, and market making.
Okay, so the big securities powers.
Yes. This broad scope really highlights GLBA's intent to allow diversified financial services under a single corporate umbrella, enabling financial institutions to offer a much wider array of products and services than before.
So, if a bank holding company wants to transition and become an FHC to engage in these new activities, what are the critical conditions it must meet beforehand? It sounds like there's some pretty strict requirements to qualify.
There are indeed crucial conditions. First and foremost, all depository institution subsidiaries of the bank holding company must be well capitalized and well managed.
Key terms there.
Absolutely. That's a non-negotiable prerequisite for entry into this expanded realm. Second, All these depository institution subsidiaries must have received a satisfactory or better CRA rating, Community Reinvestment Act rating, at their most recent examination.
Meeting community needs.
Exactly. Ensures they're meeting their community credit needs. Third, the bank holding company must formally file an election with the FRB to become an FHC.
Right, you got to tell the Fed.
You do. And there's also a grandfather provision for certain non-conforming commercial activities. This allows a company that wasn't currently a BHC but becomes one to continue some pre-existing commercial activities for a limited time, provided they don't exceed 15% of its consolidated gross revenues.
Interesting. And who is the primary supervisor for these financial holding companies with all these expanded powers?
The FRB serves as the umbrella supervisor for FHCs. Their role is to assess the FHC's overall financial condition and the systems for monitoring risks across the entire entity. This holistic oversight is critical given the expanded scope and complexity of their activities.
Makes sense. Now, beyond FHCs, GLBA also introduced specific provisions for financial subsidiaries for state non-member banks. How did the FDIC implement those provisions, and what's the definition of such a subsidiary?
Right, financial subsidiaries. To implement Section 121 of the GLBA as it pertains to state non-member banks, the FDIC added Subpart E to Part 362 of its regulations.
Okay, Part 362.
For these purposes, a financial subsidiary is defined as a subsidiary controlled by a state non-member bank that engages as principal in activities which a national bank can only conduct through a financial subsidiary.
Okay, that only is important.
It is. This distinction is important because it dictates how these entities are regulated and what additional safeguards apply. Most of the GLBA identified financial activities were actually already permissible directly for national banks, so this applies to a narrower set.
So what are the statutory criteria a state non-member bank must meet and maintain to engage in activities through such a financial subsidiary? These seem like crucial ongoing requirements.
They are. There are several key ongoing criteria. First, the state non-member bank and each insured depository institution affiliate must be, and continue to be, well capitalized.
Continuously.
Yes, and this is crucial. It's calculated after deducting the bank's investment, including retained earnings, in all financial subsidiaries. That's a direct hit to its reported capital.
Wow, okay. That's a big deduction.
It is. Second, the state non-member bank must disclose this capital deduction and the separate assets and liabilities of the subsidiary in any published financial statements, ensuring transparency. Third, the bank must comply with ongoing financial and operational safeguards. These are essentially the firewalls designed to separate the bank from the risks of the subsidiary.
Got it. Operational separation.
Fourth, the state non-member bank must comply with the GLBA amendments to Sections 23A and 23B of the FR Act regarding ongoing transactional restrictions.
Okay.
And finally, the state non-member bank and all of its insured depository affiliates must have received at least a satisfactory CRA rating at their most recent examination. Still need that satisfactory CRA.
Still need the CRA rating.
Okay.
GLBA also solidified this concept of functional regulation. What exactly does that mean for regulators like the FDIC, and what was its intent?
Functional regulation is a core principle introduced by GLBA. It essentially means that similar activities should be regulated by the same regulator. The idea is to promote efficiency and eliminate duplication.
Makes sense on the surface.
Right. So banking activities are primarily regulated by bank regulators, securities activities by securities regulators, and insurance activities by state insurance departments. The underlying intent was to prevent regulatory arbitrage and ensure a level playing field, with requirements for consultation and information sharing among regulators built right in.
Does this mean the FRB and FDIC's authority over these functionally regulated affiliates is restricted in some way?
Yes, it does, to an extent. The BHC Act was amended to restrict the FRB's authority to, say, require reports, conduct examinations, impose capital requirements, or take other direct or indirect action with respect to any functionally regulated affiliate of a depository institution.
Okay.
And importantly for us, Section 45 was added to the FDI Act, making these same restrictions applicable to the FDIC. The idea is to avoid redundant oversight when another specialized regulator is already in place.
But this restriction doesn't completely eliminate the FDIC's authority, does it? Especially when it comes to assessing risk to the insured institution itself.
Absolutely not. That's a critical point. This functional regulation concept does not alter the FDIC's fundamental authority under Section 10b(4) of the FDI Act.
That key section again.
That key section. It empowers us to examine affiliates as may be necessary to disclose fully the relationship between the depository institution and the affiliate, and two, the effect of such relationship on the depository institution.
Right.
This authority remains critical for assessing whether the activities conducted by functionally regulated entities, regardless of their primary regulator, could pose a material risk to the insured depository institution itself. It's fundamentally about protecting the deposit insurance fund.
So how does the GLBA specifically define a functionally regulated entity? What falls into that bucket?
Under GLBA, a functionally regulated entity is primarily defined by the nature of its activities and its primary regulator. It includes companies engaged in insurance activities supervised by state insurance commissioners,
Okay, insurance.
entities registered with the SEC as an investment company or as an investment advisor.
SEC registrants.
Right. And those engaged in commodity activities regulated by the Commodities Futures Trading Commission, the CFTC.
Got it. So insurance, SEC, CFTC.
Basically, yes. These definitions delineate where functional regulation applies, and they really guide interagency cooperation.
Okay, moving on to the FDIC's direct examination authority. This is really where the rubber meets the road for you, the examiner. What's the scope of this authority under Sections 10B and 10C of the FDI Act?
Right. Section 10B grants our examiners broad authority. It lets you conduct a thorough examination of all the affairs of state non-member insured banks and their affiliates. And it directs us to make a full and detailed report of the bank's condition to the FDIC.
All the affairs. Pretty broad.
It is. This authority specifically extends to those entities defined in Section 23A of the FR Act, which we just discussed. What's crucial to understand, though, is that the manner and format of these examinations aren't rigidly specified. This allows for tailored examinations.
Tailored examinations is an interesting point. Can you elaborate on why that flexibility is built in? Why not just a standard checklist?
Well, this flexibility is built in because the type of affiliate and the nature of transactions with the insured institution can vary so significantly. A one-size-fits-all approach just wouldn't be effective.
Right.
For example, the analysis required for a large commercial parent is vastly different from that for a small financial subsidiary. Also, the risk posed by affiliate activities to the insurance fund is often indirect.
Oh.
Therefore, examinations under the FDIC's 10B authority must be precisely tailored to the specific level of risk the insured institution faces as a result of transactions between and the operations of the relevant affiliates. This discretion is a key aspect of your role as an examiner to apply the right level and type of scrutiny based on the circumstances.
And Section 10C of the FDI Act grants even broader powers, including subpoena authority. How does that work in practice? That sounds pretty serious.
It is serious. Section 10C empowers the FDIC to issue subpoenas and to take testimony under oath during an examination. This power relates to any matter concerning the affairs or ownership of any such institution or affiliate.
Any matter concerning affairs or ownership.
Right. This means its reach is broad. Individuals, corporations, partnerships, or other entities that in any way affect the bank's affairs or ownership may be subpoenaed and required to produce documents. It's a powerful aid for carrying out supervisory responsibilities, ensuring we can obtain necessary information even from potentially reluctant parties.
That sounds like a very powerful tool, maybe one you don't use lightly. Are there any prerequisites or specific authorizations needed before exercising such powers, given their broad reach?
Yes, absolutely. While 10C powers are a valuable aid, their use requires careful documentation. The reasons why examinations of affiliates are considered advisable or necessary must be thoroughly documented.
Got to justify it.
Exactly. And the extent of any such examination must have prior clearance from the regional office. Furthermore, the exercise of Section 10C powers requires extensive legal documentation and should only be initiated following specific authorization from the Director, Division of Supervision and Consumer Protection, or DSC.
Okay, so it goes high up.
It does. This ensures a disciplined, legally sound, and strategically justified approach given the gravity of subpoena power.
Let's transition now to a very common structure in banking. The bank holding company, or BHC. How is a BHC defined under Section 2 of the BHC Act? Pretty fundamental definition.
It is. Under Section 2 of the BHC Act, a bank holding company is broadly defined. It includes any corporation, partnership, business trust, association, or similar organization that exercises control over any bank or over any other bank holding company.
Okay.
It's also important to note that a bank itself, being a company, can technically be a bank holding company if it controls another bank or BHC.
Interesting. A bank owning a bank.
Right. The BHC Act was amended over time to bring one bank holding companies, partnerships, and even certain bank trust departments within its scope. And as we discussed earlier, an existing BHC can become a financial holding company, an FHC, by notifying the FRB and certifying that its insured depository institution subsidiaries are well capitalized and well managed.
So the core concept here, as you said, is control. How is control specifically defined under the BHC Act for identifying these critical relationships? This seems key.
The definition of control under the BHC Act is absolutely central to identifying these relationships. A company has control over a bank or any other company if it meets one of three primary criteria.
Okay, what are they?
First, if it directly or indirectly owns, controls, or has the power to vote 25% or more of any class of voting securities of such bank or other company.
25%, the magic number.
Often, yes. Second, if it controls, in any manner, the election of a majority of the directors of such bank or other company.
Control the board.
Right. Or third, if the FRB determines, after notice and hearing, that the company exercises a controlling influence over the management or policies of the bank or company.
A bit more subjective, that last one.
It allows for flexibility. It's also important that indirect ownership, such as through a subsidiary or maybe a trust for the company's benefit, counts towards this control. Examiners often refer to FRB Regulation Y, Section 225.2, for further clarification on these nuances.
Red Y.
Yeah.
Good reference. Now, beyond these explicit definitions, there are also rebuttable presumptions of control under FRB Regulation Y. These seem to provide specific scenarios where control is presumed to exist unless proven otherwise. Can you detail a couple of these key presumptions for us?
Sure. These presumptions are crucial guidelines for you as an examiner. One common scenario is when a company owns more than 5% of a bank's voting securities and has interlocking directors or officers with the bank or holding company.
5% plus interlocks.
Right, and no other person owns as much as 5%. Another arises if a company owns more than 5% of voting securities, and additional shares are owned by individuals or their immediate family members who are also key personnel or significant owners of that company.
It's got family connections.
Exactly, and these combined holdings aggregate 25% or more. Essentially, these presumptions help identify control even when it's not a clear 25% direct ownership by looking at things like management influence or combined family holdings. There are others too, like certain management contracts or securities that are immediately convertible.
And beyond these specific scenarios, the FRB retains administrative power to determine control, right?
That's correct. The FRB may administratively determine that a company controls a bank or other company, even if it falls below, say, the 5% voting securities threshold in some cases. Conversely, there's a presumption that a company does not have control if it owns less than 5% of voting securities, unless the FRB has already found control after due process. This administrative power provides necessary flexibility to address complex or evolving ownership structures that don't fit neatly into the standard definitions.
So we've talked a lot about traditional bank holding companies, but there's this whole other category of parent companies that are not BHCs. What are the primary forms of insured banks whose parent companies don't fall under the traditional BHC definition, and why is this distinction important for you, the examiner?
Right, the non-BHC parents. The primary forms are industrial loan companies, or ILCs, and savings banks. Now, both of these entities are defined as banks under Section 3 of the FDI Act, so they are insured depository institutions.
Okay.
But they possess specific characteristics, often related to their activities or charter history, that exempt the parent companies from direct BHC Act regulation by the Federal Reserve.
So the parent isn't regulated like a BHC.
Exactly. This distinction is crucial because it means their parent companies, which can often be large commercial enterprises, operate under a different supervisory framework. This requires you, as an examiner, to adapt your assessment of potential risks and, importantly, potential sources of strength.
Okay, let's delve into ILCs specifically then. What are the specific criteria that enable an ILC to be exempt from the BHC Act, thereby allowing its commercial parent to avoid that FRB regulation as a BHC?
Good question. For the purposes of the BHC Act exemption, an ILC is generally exempt if it meets particular criteria laid out in Section 2, say, of the BHC Act. Generally, it must be an institution that either, 1, does not accept demand deposits,
No checking accounts, basically.
or 2, has total assets under $100 million, or 3, was not acquired by any company after the 1987 Competitive Equality Amendment, CEBA, Or 4, does not engage in any activity it wasn't lawfully engaged in way back on March 5th, 1987.
Quite specific historical points there.
Very. If an ILC satisfies any one of these conditions, its controlling company is typically not subject to FRB regulation as a bank holding company. Savings banks, on the other hand, are essentially state-chartered savings institutions, also with their own specific definitions and historical context.
So the key distinction, it seems, is that ILCs can be owned by commercial parent companies. How does this change the examination landscape compared to assessing a traditional BHC?
That is the key distinction. ILCs can indeed be owned by diverse commercial parent companies. Think large manufacturing firms, big retailers, insurance giants, investment banking firms.
Companies you wouldn't normally associate with owning a bank.
Precisely. This is significant because such commercial enterprises would otherwise be precluded from owning a traditional bank and being subject to the BHC Act. For you, the examiner, this means assessing a parent with potentially vast non-financial operations, very different revenue streams, and business risks compared to a pure financial holding company. It definitely complicates the assessment of the parent as a source of strength, or maybe more subtly, a potential source of weakness for the ILC subsidiary.
It sounds like while commercial parent companies can be a source of strength, providing capital and services, they also present unique challenges for examiners. What are some of those characteristics and challenges?
You're hitting on a key point there. Commercial parents can indeed provide access to capital and debt markets and a variety of technical services which can be beneficial to a subsidiary bank. However, they introduce different analytical challenges.
Like what?
Well, for one, commercial parents may lack direct management expertise relevant to financial institutions. 2, a niche bank serving specific commercial needs of the parent might be insufficiently diversified, leading to higher credit or liquidity risks.
Concentration risk.
Exactly. Furthermore, a financial catastrophe at an unrelated part of the parent company or another affiliate could unexpectedly disrupt the insured entity's earnings or operations, even if the bank itself seems healthy.
Right. Contagion risk from the non-bank side.
Precisely. This extra insured risk factor is far more complex to assess than for traditional BHCs, making simple ratio analysis often insufficient. Determining a potential source of weakness for an otherwise healthy bank due to its commercial parent is much trickier than assessing a source of strength for a weak bank.
So if an examiner needs to assess that, they should probably consult.
Right. Absolutely. Examiners should only undertake such an assessment of a commercial parent as a potential source of weakness following consultation with and direction from the regional office.
Given this complexity, what resources are available to examiners for conducting financial analysis on these non-bank holding companies or commercial parents? Where do you look?
Examiners have several sources for financial analysis. These include the parent entity's own quarterly or annual reports, Securities and Exchange Commission filings like 10Ks and 10Qs.
Public filings.
Yes. Also, the bank's own internal records on its affiliates, external industry analysis sources such as Moody's or Standard & Poor's ratings reports, internal and uncanny or external audits of the parent or affiliates, corporate press releases, and relevant newspaper articles or industry publications. It truly requires a comprehensive, almost detective-like approach to piece together the full financial picture of a diverse commercial parent.
Okay, now let's turn our attention to the overall effect a holding company, whether it's a BHC or one of these non-BHC parents, can have on its subsidiary banks. We know a strong holding company can be a source of strength, but what happens when the holding company or its non-bank subsidiaries are unsound? And what role does management play in all this?
Right. If the holding company or its non-bank subsidiaries are in an unsound condition, this can profoundly and adversely affect the subsidiary banks. The long-term health of an institution fundamentally depends on having a strong, independent, and attentive board of directors at the bank level.
The board is key.
Absolutely. The board sets the overall tone, the direction, and establishes policies for risk management and risk tolerance. They are responsible for active oversight, including reviewing major corporate actions, approving strategies and business plans, performance objectives, and those risk policies.
What else falls under their oversight?
Critically, the board must ensure the institution and its affiliates avoid conflicts of interest and comply with laws preventing the misuse of depositors' funds. They need to monitor adherence to strategies, review regulatory and audit reports, and take appropriate action. This diligent governance is paramount to protect the bank.
Beyond the board itself, what about the role of executive officers and the importance of maintaining that separate corporate existence we touched on earlier?
The board is responsible for hiring and retaining executive officers who have the appropriate skills, integrity, knowledge, and expertise for the bank's daily operations and its future planning. These officers are key to implementing the board's strategic vision.
Right.
And a crucial aspect of sound governance is ensuring the insured depository institution maintains a separate corporate existence from its affiliates. This separateness is a really sound tenet. It ensures transparency, clear accountability, and acts as a vital firewall.
That firewall concept.
Yes. All financial and other pertinent records for the financial institution affiliate must be accessible on location at the bank. You need to be able to see the bank's own records distinctly.
Makes sense. Let's move to the financial considerations. How can the holding company structure provide financial support? And conversely, what kind of financial pressures can arise from a precarious holding company condition?
Okay, on the positive side, a holding company structure can provide strong financial support. It often has a greater ability to attract and shift funds, whether through equity injections or by funding loans and investments for the bank subsidiary.
That's the source of strength idea.
Exactly. However, when the financial condition of the holding company or its non-banking subsidiaries is precarious, significant pressure can be exerted downstream onto the subsidiary banks.
How does that pressure manifest?
It can manifest in several ways. You might see demands for excessive dividends flowing upstream to the parent, or pressure on the bank to invest in higher risk assets to generate higher yields for the parent.
Chasing yield.
Right. Or maybe the bank is pressured to purchase or trade its high-quality assets for an affiliate's lower-quality assets, or purchasing unnecessary services from affiliates, or paying excessive management or other fees, all ways to push money upstream.
On that point about management and other fees, what's the FDIC's position? This seems like a common area of potential abuse, pushing money out of the bank.
It can be. While no formal policy statement has been issued, the FDIC's long-standing position is pretty clear. Management and other fees paid by subsidiary banks must have a direct relationship to the value of actual goods or services rendered.
Based on actual value.
Yes. These fees should be based on reasonable cost consistent with current market values. The bank's file should contain adequate information to determine what goods and services are being provided and on what basis they are priced. Critically, these charges should not be based simply on the bank's resources, its deposits, or its earnings.
Not just a percentage of assets or something.
Exactly. If payments are large and cannot be justified by the services received, you, the examiner, should include a comment in the report of examination. It's fundamentally about preventing undue drainage of the bank's resources.
And what about the upstreaming of funds through income tax remittances? This also sounds like a potential pressure point on a bank's capital.
It is, or at least it has been. A common method of upstreaming funds is through the remittance of income taxes to the parent, which then files a consolidated income tax return. Now, due to timing differences between call reports and income tax accounting, a portion of taxes may be deferred.
Deferred tax assets liabilities.
Right. Historically, banks sometimes remitted the entire income tax expense, both the current portion and the deferred portion, up to the holding company.
Sending cash out that represents a future tax benefit.
Precisely. However, the FDIC's statement of policy on income tax remittance by banks to holding company affiliates now mandates that past transfers of deferred taxes must be restated, and importantly, future tax transfers should only include the current portion of income tax expense. This helps prevent the bank from prematurely ceding capital that should really remain available to absorb potential losses.
Okay, that's a key policy point. And then there's this concept of double leveraging. Can you explain what that is and how it creates supervisory concerns?
Sure. Double leveraging occurs when a parent holding company issues long-term debt at the parent level and then uses those borrowed funds to inject equity capital into its bank subsidiaries.
So, debt at the top, equity at the bottom.
Exactly. While this does inject capital into the subsidiary, which looks good on the surface, excessive debt at the holding company level can generate significant pressure on the subsidiary to upstream additional dividends just to service that parent-level debt.
The dividends have to cover the parent's interest payments.
Right. Since the holding company often relies on dividends from the lead bank to service its debt, parent debt service requirements that exceed the bank's historical dividend payment capacity can place undue earnings pressure on the bank. If dividends aren't enough, the holding company might seek other ways to extract cash, like charging those excessive management fees we talked about.
So how is the double leverage ratio calculated, and what does it tell an examiner about potential risk here?
The double leverage ratio is calculated as the equity of the subsidiary, or the combined equity of all subsidiaries, divided by the equity of the holding company itself. A ratio of 100% or less means the holding company is not using double leverage, its equity equals or exceeds its investment in subsidiaries. While the comfortable amount of double leverage can vary, the core analysis for use centers on how much earnings or cash flow the subsidiaries can realistically upstream to the parent to cover the holding company's debt service and other cash needs. Even modest double leverage can create pressure if, say, non-bank subsidiaries are producing negative cash flow, which indirectly affects the bank's stability. It's a key indicator of how external debt might be putting pressure on internal bank operations.
What about fixed charge coverage as another financial measure to assess the parent company's health? How does that work?
Fixed charge coverage is another important ratio. It measures the parent company's ability to cover its interest expense and certain other fixed charges, like maybe 1/3 of rental expense. It essentially asks how many times can the parent's operating income, before interest and taxes and excluding undistributed subsidiary earnings, cover these fixed charges.
Yeah.
Generally, a ratio of 2 times or better is considered comfortable. A ratio of less than 1, however, points to a potential cash flow deficit, even before considering things like debt principal amortization or shareholder dividends.
That's red flag.
It is. Examiners must be aware of actual dividend payouts from subsidiaries, as these are typically the major source of income to a shell parent, and abnormal payouts can distort the ratio's interpretation.
And the cash flow match test. That sounds like an even more stringent measure of a parent's financial viability.
It is generally considered a more severe test. Cash flow match looks at the parent's cash availability to ensure it can meet not only interest expenses, but also its operating expenses, taxes, shareholder dividends, and upcoming debt principal maturities.
So all the cash outflows.
Pretty much all of them. Cash sources are typically all parent operating income, plus any tax credit received, or minus taxes paid. Cash uses include operating expenses, including interest, dividends paid to its own shareholders, and debt principal due within 1 year.
And what's a good level there?
A coverage ratio of 1.10 times is generally considered comfortable, meaning cash sources are 110% of uses. Ratios under 1.00 require additional study, as they presume insufficient cash flow to maintain the holding company's credit standing, which directly impacts the institution's viability and the parent's ability to be a source of strength. This ratio provides a more holistic view of the parent's ability to sustain itself and potentially support its bank subsidiary if needed.
So between these various financial ratios, double leverage, fixed charge coverage, cash flow match, which are considered the most indicative of actual financial support potential from a parent company.
That's a good question. The cash flow measures specifically fixed charge coverage, and perhaps more so, the cash flow match are generally considered the best indicators of the potential financial support a parent company can provide to a subsidiary bank.
Better than just looking at size or capital.
Often, yes. Measures like the parent's total asset size, its capitalization ratios, its revenue or profitability, even when compared to the insured institution's size, can be imperfect gauges of actual potential support. These cash flow metrics provide a more direct insight into the parent's ability to generate and manage the liquidity needed to potentially support its banking subsidiary in times of stress.
Makes sense. Moving beyond the pure financial flows, what about the benefits of economies of scale that holding companies can provide, and maybe the complexities introduced by having dual employees?
Right. Holding company structures can indeed offer significant benefits from economies of scale, particularly in areas like audit functions or data processing services, which can potentially reduce costs for the subsidiary bank.
Centralized services.
Exactly. However, the use of dual employees, those individuals who perform duties for both the banking entity and an affiliated organization, introduces complexities and potential risks.
How so?
Well, while it can be cost-effective and efficient for leveraging in-house expertise, these arrangements present increased risk if the institution and its management fail to properly monitor the hiring, training, activities, reporting lines, and expertise of these dual employees.
Needs strong governance.
Absolutely. All bank activities, even if performed by dual employees, must remain subject to the authority of an independent bank board. Bank officers, whether they are dual employees or directly employed only by the bank, must always act in the best interests of the insured institution, with sufficient expertise and authority delegated by the board.
So what should examiners look for?
You need to see a comprehensive framework of policies, procedures, and legal agreements, including things like formal written employee sharing agreements. These should govern the relationships, clearly defining compensation arrangements, reporting structures, duties, and crucially, how conflicts of interest are avoided or managed. Examiners must review these arrangements closely to ensure they align with sound corporate governance principles and don't create undue risk, blurred lines of responsibility, or hidden liabilities for the bank.
What are some miscellaneous considerations for examiners regarding holding companies, especially maybe in terms of tax benefits and loan participations in multi-bank structures?
Okay, a principal benefit often cited for forming bank holding companies, especially smaller one-bank HCs, is the tax benefit derived from issuing debt at the parent level and concurrently creating equity at the bank level through a capital injection.
That double leverage again, but for tax reasons.
Right. This was further enhanced, historically, by the Federal Reserve ruling permitting trust-preferred stock to be treated as Tier 1 capital for regulatory purposes while also being treated as debt for tax purposes, making BHCs even more attractive financially.
Got it. What else?
For multi-bank HCs, a key operational benefit is the ability for individual banks within the group to participate in loans that might exceed their individual legal lending limit, allowing the group to serve larger customers. However, this can be problematic if the originated loan exceeds the management expertise of any of the participating banks.
Risk management across the chain.
Yes. Examiners should review current business plans, ideally written ones, and ensure all service relationships with affiliates are governed by appropriate written agreements, always referring back to sections 23A and 23B for transaction limits and requirements. Finally, you should determine if the bank needs contingency plans for all critical business functions performed by affiliated companies, leveraging existing IT examination guidance for that.
Let's consider the potential impact of holding companies on the uniform bank ratings, the CAMELS ratings. How does the financial condition and capacity of HCs or these commercial parents influence those ratings?
The financial, technical, and managerial capacity of holding companies, commercial parents, and other affiliates can provide significant support to a subsidiary bank. This is especially true if the bank is a relatively small component of a much larger, financially strong corporate organization.
So it can boost the rating.
It can potentially influence it. However, examiners won't always need to conduct a detailed assessment of the parent purely as a source of strength if the subsidiary bank's ratings are already strong on their own and not really dependent on the holding company's resources. Frankly, many BHCs, particularly smaller shell holding companies, have limited independent financial capacity anyway.
When would a detailed parent exam be needed then?
A more detailed parent examination may be needed if, say, a complex commercial parent has the potential capacity to support the bank, but doesn't clearly dominate the organization financially, and if it's necessary to conclusively show that the bank ratings should reflect the holding company as a source of strength. This assessment should primarily depend on the insured institution's own independent financial condition and the direct risk presented by affiliate transactions.
And when a parent is considered a potential source of strength, how should that influence the CAMELS ratings? Is it based on potential future help?
No, that's a key point. When a holding company or parent is considered a potential source of strength, its influence on the assigned uniform bank ratings should only incorporate the actual support provided at the time of the current examination.
Based on reality now.
Yes. It should not be based on projected future resources or promises of support, but rather a current assessment of the parent's actual financial condition and demonstrated support. Furthermore, the benefits and influence on CAMELS ratings will likely change if the insured institution's own condition deteriorates.
How so?
In that scenario, the evaluation of a potential source of strength must incorporate not just the parent's capacity to support the bank, but also its present willingness to do so. Willingness can be a critical and sometimes subjective factor in times of stress. Just because they can help doesn't always mean they will.
That's a very important distinction. Can you provide some specific examples of how these factors might be considered for individual CAMELS components? How does the parent affect CAMELS?
Certainly. For capital C, you'd consider the affiliate's ability and commitment to contribute additional capital if needed, and also assess any undue dividend pressure coming from the parent onto the bank.
Okay.
For asset quality A, you look at the quality of assets generated through affiliate programs, maybe loans originated elsewhere, and the affiliate's ability to provide financial guarantees, collateral support, purchase low-quality assets from the bank, or arrange risk mitigation like credit default swaps.
Got it. Management.
For management M, factors include the independence of the bank's management and board from the parent, the bank's ability to make decisions independently, the adequacy of audit procedures covering affiliate relationships, demonstrated willingness by the parent bank to address exam recommendations, and proper documentation and protocols for all affiliate relationships.
Earnings and liquidity.
For earnings E, you examine the reasonableness of fee structures for servicing relationships and the suitability of any management fees paid up to affiliates. For liquidity L, you consider whether the affiliation provides access to funding sources the bank wouldn't otherwise have.
And finally, sensitivity.
For sensitivity S, you look at funds management strategies that might be coordinated with affiliates and the efficacy of hedging or market risk activities conducted by affiliates on behalf of or impacting the bank. Each component really assesses how the related organization tangibly impacts the bank's intrinsic health and risk profile.
Okay, let's shift gears slightly to some specific regulatory prohibitions that examiners need to be aware of. A significant one is tying arrangements. What's the statutory basis for these prohibitions, and to whom do they apply? Seems important.
Very important. The prohibitions on tying arrangements stem primarily from the Bank Holding Company Act amendments of 1970 and also Title VIII of the Financial Institutions Regulatory and Interest Rate Control Act of 1978, often called FIARA. These anti-tie-in provisions are applicable not just to traditional banks, but also to those non-bank banks we discussed, including industrial loan companies, the ILCs.
So it covers ILCs too. What exactly do these provisions prohibit a bank from doing, and what's the core purpose behind these rules? Why do we have them?
Essentially, they prohibit a bank from conditioning the availability or the price of any of its products or services upon the customer obtaining some other product or service from the bank or from an affiliate of the bank.
Buy product A, get product B cheaper type thing, but forced.
Or you must buy product B from our affiliate to get product A, like a loan from us. It also applies to conditioning the deal on the customer, providing a product or service to the bank or an affiliate, or even requiring the customer not to obtain a product or service from a competitor.
Preventing anti-competitive behavior.
Exactly. The core purpose is to prevent banks from using their unique ability to offer financial products, especially credit, coercively to gain a competitive advantage in non-banking markets. For example, a bank cannot require a loan applicant to lease equipment from the bank's holding company or subsidiary, or maybe to provide office supplies to the bank as a condition for getting that loan.
Are there any exceptions to these tying prohibitions or situations where they are not intended to interfere with, say, traditional banking practices?
Yes, there are important exceptions. These provisions are not intended to interfere with legitimate traditional banking practices. For instance, a bank may restrict the availability or vary the price of its credit, property, or services on the condition that the customer also obtains a traditional bank product, like another loan, a discount service, a deposit account, or trust service from the bank or an affiliate.
So bundling traditional bank products is okay.
Generally, yes, within limits. The intent is to prevent abuse, not hinder legitimate bundled offerings that benefit the customer. For other specific exceptions and safe harbors, which can get complex, you should always consult your regional office staff.
Okay, good advice. Another key prohibition mentioned is that of preferential loans. What does Title VIII prohibit in this regard, and why is this important for maintaining fair dealing within the banking system?
Right, preferential loans under Title VIII. This specifically prohibits preferential loans, meaning loans on better terms than available to the general public, to executive officers, directors, and principal shareholders of a bank from its correspondent bank.
From the correspondent bank.
Yes. And there's a reciprocal prohibition, too. A bank cannot open a correspondent account for another bank if that other bank has outstanding preferential loans to the first bank's executive officer, director, or principal shareholder.
So it cuts both ways.
It does. And conversely, a bank maintaining a correspondent account at another bank cannot make preferential loans to that correspondent bank's executive officer, director, or principal shareholder. It's all about preventing conflicts of interest and ensuring that relationships between banks, particularly these important correspondent relationships, are not used to provide undue personal benefit at potentially the expense of sound banking practices and fairness. Violations can result in civil money penalties.
Let's move on to another structure, chain banking groups. The manual notes these present unique supervisory challenges. How are they characterized, and what are their inherent risks, particularly when you compare them to multi-bank holding companies?
Right, chain banking groups. From a supervisory standpoint, they share some similarities with multi-bank holding companies in terms of potential benefits, like maybe some shared expertise, but also potential for unsafe and unsound practices.
But they're different somehow.
They are different structurally, and that's key. The linkage of several banks, or banks and their holding companies, under common control but without the formal top-tier registered holding company structure, creates a concentration of resources susceptible to common risks.
What kind of risks?
Things like poor loan participation practices across the group, common deficiencies in lending or investment policies that spread, problems arising from domineering or maybe absentee ownership by the controlling individual or group, insider abuses or other self-serving practices that benefit the controllers rather than the individual banks.
And detection is harder.
Detection and correction of these problems are highly dependent on the examination process itself, and they can be complicated by the fact that multiple federal and state regulatory agencies might be involved with different banks in the chain.
What are the key differences between chain banking groups and multi-bank holding companies that make off-site monitoring more difficult for chains?
The main difference, and it's a big one for supervision, is that unlike multi-bank holding companies, chain banking organizations are not required to report financial information on a consolidated basis.
No consolidated report.
Right. This significantly complicates off-site monitoring for regulators like the FDIC, as it's much harder to get a holistic financial picture of the entire group's health. Additionally, they are not subject to the same types of consolidated regulations and capital requirements as registered holding companies, creating a generally less transparent supervisory environment.
So how is a chain banking organization specifically defined for supervisory purposes? What constitutes a chain?
A chain banking organization is defined as a group of two or more banks or savings and loan associations, and/or their holding companies, which are controlled directly or indirectly by an individual or a company acting alone or maybe in concert with others.
And control here, same definition.
Similar, but with a nuance. Control here means ownership, control, or power to vote 25% or more of voting securities, or the power to control the election of a majority of directors, or the power to exercise a controlling influence over management or policies. However, the manual notes these criteria are generally interpreted narrowly in the chain banking context.
Narrowly. How so?
For instance, an individual just holding a title like chairman or president doesn't automatically imply control for chain banking purposes unless actual control over policies or management exists. It focuses more on the de facto control. Also, importantly, if the top holder of all insured institutions in the group is a registered holding company, it's generally not deemed a chain banking group for listing purposes. A single bank under a BHC or several banks owned by a single BHC aren't chains either.
Okay, that clarifies the definition. What factors should examiners consider when developing an overall supervisory strategy for these chain organizations, given their unique nature?
Several factors are critical for tailoring the supervisory strategy. You should consider the relative size and complexity of the chain's organizational structure, including how centralized its operations might be.
Centralization matters.
It does. You also need to assess the degree and nature of control or influence exerted by the controlling parties over the individual institutions and the managerial style or direct control evident at each institution.
What else?
A key focus should be on the degree of interdependence among the institutions in the chain. Look at the volume and frequency of inter-institution transactions, things like loan participations or sales between them, securities or asset purchases sales, any loans secured by BHC or bank stock within the group, insider loans or transactions involving the controlling parties, and contractual obligations for shared services.
Follow the money and the influence.
Essentially, yes. And finally, the overall financial condition of the individual institutions in the group and the chain assessed perhaps on a combined or consolidated basis, even if not formally reported that way, must be factored in to develop a comprehensive and risk-focused supervisory strategy.
Okay, let's shift back now to a detailed look at affiliates, focusing specifically on the definitions and transaction restrictions under Section 23A. Why are affiliate relationships so important for analyzing a bank's condition, and what is the FDIC's general authority here again?
Right. Affiliate relationships are critical because common ownership or management often means transactions between the bank and the affiliate may lack the objective arm's length analysis typical between independent parties. There's potential for self-dealing or disadvantageous terms for the bank.
Good.
Affiliates also offer opportunities for business endeavors that might be prohibited directly to the bank itself, yet these activities can still profoundly affect the bank's condition through the relationship. Recognizing this, the FDIC is granted authority under Section 10b-4 that we discussed to examine affiliates in connection with its examination of an insured bank, ensuring we can fully understand and mitigate potential risks stemming from these connections.
Okay. The manual details four major types of affiliates defined specifically in Section 23A of the Federal Reserve Act. Let's break those down. First, the parent holding company and its subsidiaries. How does 23A define this?
Okay, this first category under 23A includes any company that controls the bank, that's the holding company, as well as any other company controlled by that same holding company, which would be a sister subsidiary to the bank. Both the parent HC and the sister sub are considered affiliates of the bank under Section 23A.
And control here is the 25%, or board control again.
Yes. Control for 23A purposes is defined similarly but not identically to the BHC Act. Owning, controlling, voting 25% or more of voting securities, or controlling the election of a majority of directors or trustees. Company is also broadly defined.
Is there an exemption within this category?
Yes, an important exemption exists for domestic banks that are 80% or more controlled by the same holding company. Transactions between these sister banks are largely unrestricted by 23A quantitative limits and collateral requirements, although the prohibition against purchasing low-quality assets still applies, as does the general requirement for safe and sound practices.
80% controlled sister banks get treated differently.
Correct. But all the 23A restrictions do apply to transactions between the bank and its parent holding company itself, its non-bank subsidiaries, any bank subsidiaries that don't meet that 80% common control exemption, and any affiliated foreign banks, even if 80% owned. The 80% ownership test generally aligns with the minimum required for filing consolidated federal income tax returns.
Okay. What about the second category defined in 23A? Bank subsidiaries. How do they differ from non-bank and foreign bank subsidiaries in this specific context?
The second category involves domestic bank subsidiaries directly controlled by another bank. For Section 23A purposes, such a domestic bank subsidiary is an affiliate of the controlling parent bank.
Bank owning a bank again.
Right. And if this bank subsidiary is 80% or more controlled by the parent bank, it receives the same exemption from most 23A restrictions as sister banks in a holding company structure, ensuring consistent treatment based on that 80% threshold.
But what about non-bank subsidiaries owned directly by the bank?
That's the key difference here. Non-bank subsidiaries and foreign bank subsidiaries that are directly owned by the bank are typically excluded from 23A's definition of an affiliate. This is unlike the situation where they are subsidiaries of a holding company.
Why the exclusion?
The rationale historically was that bank-owned non-bank subsidiaries, like premises subs or safe deposit subs, were considered an integral part of the bank's operations, and most banks were restricted in stock ownership anyway. However, if a non-bank subsidiary, even though excluded by definition, exposes the bank to undue risk, maybe state law allows activities national banks can't do, examiners can recommend bringing transactions with that subsidiary under 23A restrictions by specific FDIC order or regulation.
Okay, so there's a safety valve there. That brings us to the third type, interlocking companies. How are these defined as affiliates under 23A?
These are companies that are interlocked with a banking organization through common ownership or common directors. A company is an affiliate under 23A if 25% or more of its voting shares are owned or controlled by or held for the benefit of shareholders who also own or control 25% or more of the voting shares of either the bank or its parent holding company.
Common shareholders.
Right. Alternatively, it's an affiliate if a majority of the company's board of directors also constitutes a majority of the board of the bank or its parent holding company.
Common directors.
Yes. This definition often becomes applicable to those chains of one-bank holding companies we discussed if they are interlocked at the holding company level. If the criteria are met, both the chain HCs and their subsidiary banks can become affiliates of each other for 23A purposes.
And finally, the fourth category defined in 23A, sponsored and advised affiliates. What falls under this?
This category includes any company that is sponsored and advised on a contractual basis by a bank or by any of the bank's subsidiaries or affiliates. Real estate investment trusts, or REITs, advised by a bank are a common example.
Okay.
It also explicitly includes any investment company for which a bank or any of its subsidiaries or affiliates serves as an investment advisor, meaning it regularly furnishes advice on securities or determines which securities are purchased or sold.
Mutual funds advised by the bank group.
Exactly. The rationale for including these types of affiliations under 23A is to prevent banks from engaging in less than arm's length transactions, perhaps to prop up a fund they advise or to protect their reputation from bad advice they gave. Applying 23A's limits and collateral rules controls the bank's potential loss exposure in such situations, ensuring transactions are conducted more objectively.
Let's move to the restrictions on covered transactions with these defined affiliates under Section 23A. What are the aggregate limits for these transactions, and what exactly constitutes a covered transaction? Seems like the core of 23A.
It really is. Section 23A imposes strict quantitative limits. Covered transactions between a bank and any single affiliate cannot exceed 10% of the bank's capital stock and surplus.
10% per affiliate.
And the aggregate amount of covered transactions with all affiliates combined cannot exceed 20% of the bank's capital stock and surplus.
20% overall.
Right. And capital stock and surplus here is generally interpreted by the agencies to include not just par value, but also things like undivided profits, capital reserves, and certain valuation reserves.
What's a covered transaction?
23AB7 specifically lists them. It primarily includes loans or extensions of credit to an affiliate, a purchase of or investment in securities issued by an affiliate, a purchase of non-exempt assets from an affiliate, the acceptance of securities issued by an affiliated company as collateral for a loan or extension of credit to any person or company, and the issuance of a guarantee, acceptance, or letter of credit on behalf of or for the account of an affiliate.
Pretty comprehensive list.
It covers most ways a bank could push resources to an affiliate. And importantly, the GLBA added an anti-evasion rule stating that any purchase of or investment in a financial subsidiary by an affiliate of the bank is treated as if the bank itself made the purchase or investment. This prevents using affiliates to circumvent the bank's own investment limits in financial subs.
Smart. Now, Section 23A also contains a critical prohibition on the purchase of low-quality assets from affiliates. Can a bank ever purchase these, and how is low-quality assets specifically defined?
Generally, no. A bank cannot purchase any low-quality asset from an affiliate. The only exception is if the bank had made a commitment to purchase the asset prior to the affiliate acquiring it, and that commitment was based on an independent credit evaluation by the bank at the time.
So, no bailing out affiliates by buying their bad assets.
That's the intent. This prohibition extends to the bank's subsidiaries as well. Neither the bank nor its subsidiaries can buy low-quality assets from an affiliate.
And the definition. What's low quality?
It's broadly defined to capture assets already showing signs of trouble. This includes any asset classified as substandard, doubtful, or loss, or even other loans especially mentioned in the most recent examination report of an affiliate. It also includes assets in non-accrual status due to deteriorating credit quality or being past due, assets with principal or interest payments more than 30 days past due, or assets whose terms have been renegotiated or compromised due to the obligor's deteriorating financial condition. It's a pretty stringent definition aimed squarely at preventing affiliates from offloading their problem assets onto the bank.
Very clear. What about collateral requirements for loans to affiliates, or guarantees and letters of credit issued for them? This seems vital for mitigating the risk in those covered transactions.
Absolutely vital. Loans or extensions of credit to affiliates or guarantees acceptances letters of credit issued on their behalf are permitted only if they are secured by specific types and amounts of collateral at the time the transaction is made.
What kind of collateral and how much?
The type of collateral dictates the required margin or haircut. If the collateral is U.S. government or agency securities or specifically segregated deposit balances held at the bank, or obligations eligible for Federal Reserve Bank rediscount or purchase, then the collateral value must be 100% of the credit extended.
Okay, 100% for the safest stuff.
Right. If it's obligations of a state or political subdivision, the margin is 110%.
Yeah.
For other debt instruments, including receivables, it's 120%. And for stocks, leases, or other real or personal property, the collateral value must be 130% of the loan amount.
Higher margins for riskier collateral.
Exactly. The valuation is based on market value at the time of the transaction. And importantly, if collateral is later retired or amortized such that the margin becomes insufficient, additional eligible collateral must be supplied to meet the original requirement.
Does the bank have to top up if the market value just drops?
Generally, no. Shrinkage in value alone, without substitutions or amortizations, doesn't create a violation if the initial margin requirement was met.
What can't be used as collateral?
Two key restrictions. Those low-quality assets we just defined cannot be used as collateral, and securities issued by an affiliate of the bank cannot be used to secure the obligations of that affiliate or any other affiliate of the bank. This prevents circular pledging within the group. All these rules ensure the bank is adequately protected against potential losses from these affiliate transactions.
Makes sense. Finally, let's briefly touch on Section 23B of the Federal Reserve Act.
Mhm.
What are its core restrictions and how does it relate to or build upon Section 23A?
Right, 23B. It also applies to insured non-member banks via Section 18J of the FDI Act, and violations can trigger civil money penalties. Section 23B essentially extends the principles of arm's length dealings that were initiated by 23A. It has four main restrictions.
What are they?
1. Covered transactions, as defined in 23A, plus some others like asset sales to an affiliate, must be on terms and under circumstances, including credit standards, that are substantially the same, or at least as favorable to the bank, as those prevailing at the time for comparable transactions with non-affiliated companies. Basically an arm's length standard.
Market terms.
Yes. 2, it restricts a bank, when acting as a fiduciary, from purchasing securities and other assets from an affiliate unless lawfully authorized by the trust instrument, court order, or local law.
Protects trust beneficiaries.
3, it restricts a bank and its subsidiaries from purchasing securities during an underwriting where an affiliate is a principal underwriter, with some exceptions.
Limits underwriting conflicts.
And 4, it prohibits the bank or its affiliates from publishing any advertisement or entering any agreement suggesting or stating that the bank is responsible for the obligations of its affiliates. Maintain that separation.
Don't imply the bank backs the affiliate's debts.
Exactly. Generally, 23B incorporates the affiliate definitions from 23A, but notably, banks themselves are not considered affiliates of each other for most 23B purposes. This avoids routine interbank transactions from falling under its more stringent market terms requirements.
Now let's move specifically to subsidiaries of the bank itself. How is a subsidiary defined under Section 23A of the FR Act, and what's the overall risk their condition presents to the parent bank? This seems distinct from the affiliate definition we just discussed.
It is distinct, though related. A subsidiary, as defined by Section 23A of the FR Act, is any company where 25% or more of any class of its voting stock is owned, controlled, or held with power to vote by the bank, or any company where the bank controls the election of a majority of its directors or trustees.
So controlled by the bank, not just by a common parent.
Precisely. Now, while some non-bank subsidiaries were historically excluded from 23A affiliate rules, remember that post-GLBA, those non-bank subsidiaries that qualify as financial subsidiaries under Section 46 of the FDI Act are now explicitly treated as affiliates for 23A purposes.
Okay, so financial subs are affiliates now, but what about other subsidiaries?
For other subsidiaries, their condition can still substantially affect the bank's affairs and soundness, perhaps even more directly than some affiliates. Unlike affiliates whose risks might be somewhat mitigated by holding company structures or 23AB limits, a financially distressed subsidiary can directly drain the bank's management time and financial resources.
More direct impact potential.
Yes. And crucially, the liabilities of a subsidiary may potentially flow directly through to the insured institution parent if appropriate firewalls. Those barriers to protect the bank are not properly established and maintained. Even with barriers, legal precedents mean there's no absolute guarantee of insulation.
So the examiner's job.
Your objective as an examiner is to evaluate the risk presented by the subsidiary to the parent institution to determine the parent organization's true consolidated condition.
Okay, so for functionally regulated subsidiaries, say an insurance sub or a broker-dealer sub, how does functional regulation apply to their examination by the FDIC, and when can the FDIC conduct direct examinations of these?
Right, functional regulation applies here too. For functionally regulated subsidiaries, GLBA mandates that the FDIC rely to the fullest extent possible on the work of the functional regulator, meaning we should leverage their examination reports and findings whenever feasible.
Rely on the insurance commissioner or the SEC first?
Generally, yes. Direct FDIC examinations of these functionally regulated subsidiaries are generally permissible only if certain conditions are met. 1. If there's reasonable cause to believe the subsidiary's activities pose material risk to the parent depository institution. 2. If an examination is necessary to assess the bank's overall risk management systems. Or 3, if the subsidiary is not in compliance with a law that the FDIC has specific jurisdiction to enforce against it, like 23AB, if applicable.
Specific triggers for direct exam.
Correct. If a high-risk profile is evident in the subsidiary, more extensive FDIC procedures may be required. But the key takeaway is, for a functionally regulated subsidiary, you should always contact your regional office before proceeding with any direct examination of the subsidiary's records or operations.
Consult first.
Always. In the meantime, it's crucial to review and assess the adequacy of any records the bank maintains regarding the subsidiary, including written policies and procedures concerning the bank's own oversight of that subsidiary. The objective is to reach a level of comfort sufficient to assess the subsidiary's overall condition and its potential impact on the parent bank.
Let's quickly review some major types of subsidiaries examiners might encounter, highlighting their unique aspects. First up, bank service corporations, BSEs. What are they?
A BSC, defined by the Bank Service Corporation Act, is a corporation whose capital stock is owned by one or more insured banks, formed to perform authorized services for those banks. These services can range from clerical, bookkeeping, accounting, data processing, to activities permissible for BHCs under FRB Regulation Wise Section 4C8.
So shared service centers, basically.
Often, yes. The BSC Act limits the amount a bank can invest and requires prior regulatory approval for investment. Importantly for examiners, the BSC Act gives the FDIC direct authority to regulate and examine BSCs serving state non-member banks as if the services were performed by the bank itself on its own premises. Banks also have to notify their regulator when they start using a BSC.
Okay. And what about safe deposit corporations and corporations holding title to bank premises? These seem pretty straightforward.
They often are. Safe deposit corporations primarily offer safe deposit box services, often established as separate entities under state statutes to potentially limit the bank's liability related to box contents. They should operate with the same internal procedures as a bank's own safe deposit department and be protected by appropriate insurance.
And premises corporations.
Corporations holding title to bank premises simply own the bank's physical property, land, and buildings, and typically lease it back to the bank. The construction or acquisition is often financed with borrowed money, and the lease payments are structured to service the principal and interest on that debt. State law often limits the maximum amount a non-member bank can invest in such a subsidiary. Examiners must fully consolidate these majority-owned bank premises subsidiaries when evaluating the parent bank's condition and earnings, as the investment amount and lease payments significantly affect the bank's financials.
Got it. What about other key types? Securities firms, subsidiaries, small business investment companies, SBICs, agricultural credit corporations, ACCs, and those special purpose finance subsidiaries.
Okay, quickly. A securities firm subsidiary is one that engages in the sale, distribution, or underwriting of securities, maybe acts as an investment advisor to an investment company, or conducts other activities requiring SEC registration as a broker-dealer. Small business investment companies, SBIs, are organized under the Small Business Investment Act of 1958 to provide long-term credit and equity financing for small businesses. Banks, national member and non-member if state law permits, can generally invest up to 5% of their capital and surplus in SBICs, but cannot acquire 50% or more voting control.
Okay. ACCs and special purpose.
Agricultural credit corporations, ACCs, are typically established under state law as a means for a bank to obtain funding for its agricultural customers, often through a financing relationship with a Federal Intermediate Credit Bank, FICB. They discount loans at the FICB, usually on a full recourse basis back to the ACC and potentially the bank. They are examined by the Farm Credit Administration, successor to FICB. Examiners need to watch for concentration risk here. Special purpose finance subsidiaries are mechanisms for raising funds from outside investors, often by issuing collateralized debt, like CMOs or preferred stock, backed by assets transferred from parent bank. While they can enhance asset restructuring or funding, they can also be used solely for arbitrage profits. Examiners must review their consolidation requirements per call report instructions, capital adequacy impact, they often increase assets without increasing capital, and risk management strategies to ensure they don't pose undue risk to the parent bank.
We also see corporations engaged in international banking activities, like EDGAX corporations, and specialized entities like mortgage banking, insurance, and real estate subsidiaries. What are the key examiner considerations for these?
Right. EDGE Act corporations are federally chartered under Section 25A of the FR Act and Reg K, specifically for international banking and finance activities only. They are chartered and regulated by the FRB. Agreement corporations are state chartered but agree to operate under the same limitations as EDGE Acts. Mortgage banking subsidiaries originate or purchase mortgages primarily for sale into the secondary market and often retain the servicing. Examiners focus on their origination quality, secondary marketing, risk management, hedging, warehousing, and servicing operations. Insurance subsidiaries engage in insurance agency, brokerage, or underwriting, but permissible activities vary significantly by state law, and they are generally regulated primarily by state insurance departments. For real estate subsidiaries, permissible activities like brokerage, equity participations, or development also vary greatly by state law, and investment limits often apply. It's critical to remember that real estate development and investment are generally not permitted for national banks or their subsidiaries. State non-member banks can engage in these activities only if authorized by state law and they receive prior approval from the FDIC under Section 24 of the FDI Act. Real estate brokerage, being an agency activity, generally doesn't require FDIC approval. For all these specialized subs, examiners must evaluate the subsidiary's risk to the parent, including potential direct liability flow and the adequacy of those firewalls.
So, when examining any of these subsidiaries in depth, what specific procedures should examiners follow, and how should they assess management effectiveness and the strength of those firewalls?
Okay, an in-depth evaluation of a subsidiary, regardless of type, unless functionally regulated, where you rely on the primary regulator first, generally involves assessing several key areas you need to look at. Asset quality, ascertain the quality of assets held by the sub, review delinquency reports, evaluate the parent bank's management oversight and loss provisioning policies for the sub.
Right, bank oversight is key.
Absolutely. Then, funding and liquidity determine the types of funding the sub uses, the reliability, and the extent of funding provided by the parent bank. Assess for excessive reliance on single sources or on the parent. Then, adequacy of capital, determine if the subsidiary's capital is adequate given its asset quality, funding, earnings, and management. Compare it to regulatory standards if applicable or industry norms. A strong capital cushion at the sub-level helps insulate the bank.
How do you view that capital relative to the bank?
A useful analysis is to deduct the bank's equity investment in the subsidiary from both the bank's assets and its capital. This helps analyze the potential effect of the subsidiary becoming insolvent on the parent bank's own capital adequacy.
Simulates a write-off. Got it. What else?
You need to assess earnings review the subsidiary's earnings stream. Is it reliant on volatile one-time gains? Is it failing to recognize losses in a timely manner? Review any fees paid between the bank and sub, salary structures, overhead expenses, ensure charges are market-aligned and fair to the bank. And finally, management.
What about management and firewalls specifically?
The subsidiary's daily management should be structured to avoid the presumption that its activities are actually being conducted by the bank. Advertising and disclosures must be reviewed to ensure the public perception is not that the subsidiary's activities are guaranteed by the bank or insured by the FDIC. And crucially, examiners must assess those firewalls, the concept of separation. Are there separate corporate formalities, separate management and employees where appropriate, separate accounting systems and policies? Is there physical distinction of operations? You should review compliance with specific FDIC rules, like Section 362.4c, designed to ensure insulation of the bank from subsidiary risks. Strong firewalls are essential.
Okay, our final section today covers something slightly different. Examination and investigation of unaffiliated third-party servicers. Why is it sometimes necessary for the FDIC to examine these parties, even if they aren't affiliates or subsidiaries in the traditional sense?
Right. Situations occasionally arise where an insured depository institution's safety and soundness might be materially affected by its transactions, contracts, or business arrangements with parties that are not formally affiliated with the institution. Think critical vendors, loan servicers, payment processors, etc.
Third parties doing critical functions.
Exactly. When the relationship with or the performance of such an unaffiliated third party could materially impact the bank, it may become necessary for the FDIC to examine the other side of that transaction or arrangement to fully understand its nature and its potential effect on the insured institution. The potential impact of these business relationships, even with unaffiliated third parties, necessitates a complete understanding for you to carry out your mandate and assess the full risk profile of the bank.
Does the FDIC actually have statutory authority to obtain records from these unaffiliated parties? I mean, they aren't owned or controlled by the bank?
Yes, the FDIC does possess statutory authority to obtain records from unaffiliated service providers and other counterparties relating to an insured financial institution. Now, this authority isn't unqualified. It depends on the specific facts and circumstances of the situation.
Where does that authority come from?
It's supported by several statutory provisions, including Sections 10b and 10c of the FDI Act, our general examination and subpoena powers, and importantly, Section 7c of the Bank Service Corporation Act, which specifically addresses entities providing services to banks. Also relevant are the definitions of institution-affiliated party in Section 3w of the FDI Act.
And the scope? Can you look at everything?
The scope of information obtainable is not limited just to the specific transactions with the bank. It can potentially extend to the servicer's or entity's own financial books and records if that information is deemed necessary to further an examination relating to the affairs of an insured bank. It's a critical power to ensure full transparency when third-party relationships pose material risk.
So what should an examiner do if they conclude that information is needed from an unaffiliated service provider or some other counterparty to the bank? What's the process?
It's important for you, as an examiner, to always maintain awareness of material third-party transactions, service contracts, or other business arrangements that could potentially have a material effect on an insured bank you're examining. If you conclude that information is needed from an unaffiliated service provider or other counterparty to the bank to complete your assessment, you should consult with your regional office.
Talk to the RO again.
Yes. The regional office will then assist you in determining whether obtaining the information directly from the third party is indeed necessary and appropriate, and if so, they will assist in obtaining that information, possibly using the statutory authorities we just discussed. This ensures a coordinated, legally sound, and risk-focused approach to gathering information from entities that, while not affiliates or subsidiaries, still significantly impact the bank's safety and soundness. And remember, the examination authority for actual bank service corporations is specifically set out more directly in Section 7 of the BSC Act itself.
And that brings us to the end of this pretty intensive deep dive. We've systematically unpacked the complex world of related organizations, starting with those foundational statutory definitions in the Federal Reserve Act and the FDI Act.
Right, through the really transformative effects of the Gramm-Leach-Bliley Act on financial holding companies and financial subsidiaries, and touching on the critical role of functional regulation and how that interacts with FDIC authority.
We explore the nuances of bank holding company structures, the unique challenges posed by those commercial parents owning ILCs, and the profound impact these relationships can have on a subsidiary bank's management and financial health, including key metrics like double leverage and cash flow coverage.
We also delved into specific regulatory prohibitions like tying arrangements and preferential loans between correspondents, and discussed the distinct supervisory considerations needed for chain banking groups which lack that consolidated reporting.
And finally, we highlighted the multifaceted nature of bank subsidiaries, detailing various common types and the focused examination approach required for each, as well as clarifying your authority over critical unaffiliated third-party servicers.
Yeah, this deep dive truly underscores that understanding related organizations, this whole Section 4.3, isn't just about checking boxes for compliance. It's fundamentally about anticipating risk, identifying potential sources of weakness or strength, and ultimately ensuring the stability of the financial system that you, as an FDIC examiner, help protect every day.
Your vigilance in assessing these interconnections, everything from corporate governance structures and board independence down to financial flows, fee arrangements, and dual employee setups, it really is paramount.
It absolutely is.
So here's a final thought to consider. Given the continuous evolution of financial structures and the increasing complexity of these inter-entity relationships, how might technology, think AI, big data analytics, red tech, how might technology further enhance or perhaps complicate the transparency required for effective examination of related organizations in the future? And what new challenges or maybe opportunities does that present for regulatory oversight down the road?
That's a fascinating question. How technology changes our ability to see through these complex webs. That's where it gets really interesting for the future of supervision.
Something to think about. Thank you for joining us for this crucial deep dive into related organizations.